Hello, welcome. Thank you so much for joining. Thank you for being here. Let's jump right in. How do you deal with questions about buying property, whether you want to buy a property for yourself or whether you want to buy a rental property as a source of income? How do you grapple with these questions given the fact that we are facing high home costs generally, high interest rates, and low inventory? We're going to tackle all of these one by one, and we're going to kick off by I'm going to kick off by answering two questions that came from you, from the Afford Anything community. I'm going to answer two questions that I received by email from subscribers to our newsletter and our VIP list. And after that, I will open it up to you who are here live. So if you have any questions, just drop them into the comment section, and I will answer the questions that come up in the comment section as they come up. So I'll start with this question, which I received by email from a newsletter subscriber. This person says, my wife and I live in a single family home in a relatively low cost of living city. Awesome. Amazing. For those, my editorializing as I read the question, for those of you who are, whose jobs and families and whose life works out to live in a low cost of living area, you've got a great advantage. So that's fantastic. You've managed to lock in. My wife and I live in a single family home in a low cost of living city state, and we've managed to lock in a fantastic refinanced 15-year mortgage rate, sub 2%. Wow. A less than 2% mortgage rate locked in 2020. Incredible. Absolutely incredible. But this person goes on to say, we are considering purchasing and moving to a new home within the next 2 to 3 years that better fits our family's needs. And they are very much in a golden handcuff scenario. And so the person then asks, we're considering whether to sell the house and harvest the capital gains free appreciated value, which is approximately $160,000, or whether to keep the house and convert it into our first rental property. Okay, wow, there's a lot to unpack here. So first of all, thank you for the question. And second of all, congratulations. Let's just go through all of those details again, because it is absolutely incredible what you've got. You've got a home, a primary residence with a mortgage interest rate that's less than 2%. What's incredible about buying something on a primary residence mortgage is that and you, the person who asked, probably knows this, but I'm saying this for the benefit of anybody else who is watching this video who might not be aware of this. What is absolutely incredible about a primary residence mortgage is the fact that as long as you live in that home for what is considered a bona fide period of time, which is typically around 1 year, you get to keep it as a primary residence mortgage for the remainder of the mortgage term, even if you use it as a rental property. And again, to the person who sent in the question, I'm sure knows that, but sometimes there are beginners in the rental property space who aren't aware of that, so I just want to make that clear. The primary residence mortgage that you have, you get to keep as a primary residence mortgage, even if the use of it changes. So you've got that mortgage rate locked in. You also have an incredible capital gain that you've made on the property, which is fantastic. And so let's talk about your question. Do you harvest that gain, or do you use this as a rental property? I've got a couple of questions, and I've got a homework assignment for you as you figure it out. The first thing that I want you to figure out is, if you were to hold it as a rental property, what would be the cap rate on that property? Now, the cap rate, let me write this out. So the cap rate is essentially the dividend. Put that on the screen. So the cap rate is essentially the dividend that your property makes. And the way that you would figure out the cap rate is you calculate the gross rent divided by the net operating income of the, I'm sorry. Let me take the gross rent minus the operating income of the property. Gross rent minus operating income, that is the net operating income, and the net operating income divided by the purchase price of the property is your cap rate. And so what you would do is step one, you would calculate the cap rate on that property. That tells you what kind of dividend, what kind of unleveraged dividend the property is yielding for you. And what's nice about this is that you're not taking the refinance into consideration when you're calculating the cap rate. Notice that the equation, which is gross rent minus operating expenses equals net rent, and then net operating income, and net operating income divided by purchase price equals cap rate, right? Notice that there's nothing about financing related to that. So what's nice about calculating cap rate is you get to assess the viability of the property itself as a rental, absent any financing considerations. So figure out what the cap rate is on your property, all right? And then that's step one. Step two is make an estimate for reasonably how much you think this property will appreciate over the long term. Now, I know you already have $160,000 in equity gains that you've made on this property. You bought in 2020, and so you've probably seen some strong appreciation. However, the appreciation that we saw 2020 to 2021 was an anomaly. That's not something that we can expect to repeat. So in terms of the long-term trajectory of this particular neighborhood, what do you think is a reasonable estimate for its market-based appreciation? And you can just look at history. If you don't want to make projections about the future, just look at the historic average. What is the historic average appreciation rate over the last 20 years? Now, we can get into arguments as to whether that's a good or bad way to approach it, because there's some people who will argue, well, the historic appreciation rate of a given neighborhood doesn't take into account the fact that there could be bona fide fundamental changes to a given neighborhood, jobs, population growth, etc., that makes the future prospects of that neighborhood different than the past. That we get into a very neighborhood-specific conversation when we go there, but you can either estimate the appreciation of the neighborhood by actually making a projection of the future, or you can estimate the appreciation of the neighborhood by looking at historic averages. Or, just for the sake of an academic exercise, you could take a look at both and then run a couple of scenarios, run a couple of equations, doing one of each. But so then what you would want to calculate then is cap rate plus market-based appreciation, I'm writing this out, is unleveraged total return. I'm putting that on the screen. All right. So once you know your cap rate, and once you add that to that market-based appreciation in whichever way that you estimate that, those two added together is the total return that this home would provide, absent any financing considerations. So by virtue of making this calculation, you get to see what kind of a return this home would make, even if you weren't thinking about the cost of borrowing at all. So you're not letting the cost of borrowing influence your decision, all right? Figure out what this number is on your property. That in and of itself will give you a strong basis on whether or not this is the type of property that you think is worth holding for the long term. Because if the cap rate is, we'll use an extreme example. Let's say the cap rate is 1%, and let's say market-based appreciation historically, let's really go worst case. Let's say that historically you live in a neighborhood that has not even kept up with inflation. And there are places like that. Look at Cincinnati in the 1990s, right? Cincinnati in the 1990s did not keep pace with inflation. So, Cincinnati is not, I'm not picking on it. It's not an anomaly. There were a lot of places that fit that description. So, let's just take a worst case scenario. Let's say the cap rate is 1%. Historic market-based appreciation where you live has been 2% over the last 20 years or over the last 30 years, right? Now we're talking about an unleveraged total return of 3%. I mean, that's just not worth fighting for. You can get a better risk-free return if you were to put your money in um, a high yield saving. I mean, right now you could do it in a high yield savings account. You could get a better return in treasury inflation protected securities. Um, so using that worst case scenario, an unleveraged total return of about 3% in that hypothetical would just not be worthwhile. Now, by contrast, let's say that you have calculated that you're getting a cap rate of maybe 6% and that market-based appreciation in your neighborhood, let's just say that the historic average of your neighborhood over the last 20 to 30 years historically has been, I don't know, 5%, right? So now we're talking about 6% cap rate plus 5% historic market-based appreciation. We're talking about an unleveraged total return of 11%. That's pretty impressive. That's very impressive. And so then we're talking about a situation in which you've borrowed money at less than 2% in order to hold an asset that's producing an unleveraged 11% return. So in that case, there's a very strong argument for holding on to this property. So that's the equation that I want you to do as you're figuring out which of those options you would consider. Uh, Part of the reason that I emphasize cap rate so much, and part of the reason that I emphasize unleveraged total return so much, is to go back to your question. This is a 15-year mortgage. You locked it in 2020, so you are 11 years away from holding this property free and clear, absolutely free and clear. And so 11 years for, let's just assume that you were to hold the property. 11 years from now, when the property is completely paid off, is this the type of property that has a cap rate that is good enough that it would be worth holding on to? Because if it's not worth holding on to in cash, if it's not worth holding on to when you own it free and clear, then it's not worth holding on to with a mortgage. And that's another way of saying uh don't use a low mortgage rate to make a good deal look bad. Like there are some people, not you, but there are some people who would say, well, I'm going to hold on to anything that has a sub 2% mortgage interest rate because of the fact that I'm borrowing money at such a cheap cost in order to hold on to this asset. So there are some people out there who would just say, hey, you know what, if I can borrow at less than 2%, why wouldn't I? But what I like about your question is that you're not taking that approach. What you're essentially asking is, um, you know, is this property, is it worth holding? We have the opportunity to to lock in our gains and leave, right? Because that's what you would be doing if you were to sell the home to harvest the appreciation. You have the opportunity right now to lock in those gains, and walk away. Um, and so you're asking the question, should I lock it in and walk away, or should I hold? And knowing what type of return this asset is getting absent that financing, that's going to give you that answer. So the other thing, you mentioned that the appreciated value, if you were to lock it in right now, if you were to sell right now, is free of any capital gains. While that is a great perk, I would not let the tax tail wag the decision dog. Meaning, if it's worth holding on to, based on this formula, if it's worth holding on to, then hold on to it. If it's worth selling, then sell it. But don't let the fact that you can harvest this free of any capital gains, don't let that be the deciding factor. Because even if you were to hold this as a rental property, you could always indefinitely defer the capital gains through what's called a 1031 exchange. So there are ways of deferring capital gains tax, and B, ultimately, you don't want the tax tail to wag the decision dog. Ultimately, you want to make the decision that will generate the most wealth in the long term. And then once you've made that decision, figure out how to tax optimize it, but start with the decision itself rather than starting with the tax consideration. So that is my answer to that question. Um, Now, let's go to another question. This question came from, and thank you for sending that in, and thank you also for being part of the VIP list. And by the way, if you haven't seen it, yet, for anybody who's watching this, our course, Your First Rental Property, is open for enrollment right now. If you go to this page, affordanything.com/enroll, you'll get a lot of information about it. Now, with that said, let's go to our next question. And this question asks, I'll stop this little ticker. All right. So this is a new question from a different person, and this person asks, what would be your threshold for refinancing a mortgage for a rental property if interest rates do drop in the future? Would that threshold be 1/2 of a percentage point lower than your current rate? Would that threshold be 1% lower than your current rate? And then the person also goes on to say, I bought a rental property last year. Congratulations. Congratulations. And I have a mortgage interest rate of 7.375%. I'm currently breaking even with the rent that I currently get, and I'm hoping to increase the rent with the next renewal. I'm also hoping to reduce my monthly payment by refinancing the mortgage if the rates drop. My mortgage lender promised one free refinance before December of 2024. All right. Awesome. Thank you. First of all, congratulations on buying your first rental property. Now let's talk through your question. First of all, mortgage rates. Here's some context for understanding what our current mortgage interest rate environment. I'm going to say a few things. Number one, I know this is very little solace, but mortgage interest rates, although they feel high right now, they are historically normal. Nobody likes hearing that because the pain is real to you. The it's not FOMO. What's the word for FOMO when the thing has already passed? Like there was this time in relatively recent history when you could have gotten a low interest rate loan, but because we had the ZIRP era, the zero interest rate policy era, and now we're at a different point in history where rates are historically normal, but they don't feel normal because recency bias leads us to compare today's rates with the rates that were available in very, very recent and very, very memorable history. And so, this is sort of a broad statement for everybody who's watching. If you think about, the last time that we had interest rates like this was around 2000, 2001, 2002. Right in that era, we had very similar mortgage interest rates, right around the 7% mark, 7%, 8% mark. And if you bought a rental property in 2002, and if you still held on to that rental property today, you would be, you would have survived the Great Recession, which would have been a very scary time. But even with the Great Recession, if you would have bought a rental property in 2001, 2002, and you still had it today, you would have created an enormous amount of wealth for yourself. So that's the first thing that I want to remind everyone of is mortgage interest rates right now are historically normal, and real estate is the long game. And when you're playing the long game, despite the fact that in a given year, it kind of feels like, what am I doing? Over the long term, historically, properties have built wealth. And I think the best analogy to the time period that we're going through right now is imagine that you bought a home in 2001 or 2002. You're doing the equivalent of that today for your future self 20 years down the road. So That said, let's address your question directly. You have one free refinance before December of 2024. The absolute best case scenario, and I think that there is a near zero chance that this will work, but you might as well send the email or make the phone call just to see if it can, but I think there's almost a zero chance that this will work. See if you can get that extended. The answer is almost certainly going to be no, but see if you can get it extended. Just ask the question. Be prepared for the answer to be no. Be prepared for the answer to be, sorry, December 2024 is a firm deadline. Be like 100% prepared for that. But just because the answer is no doesn't mean you shouldn't ask the question. So, step one, see if you can get it extended. Most likely the answer is no. Step two, given that refi has to be before December 2024, wait until as late as possible. You want to be right up to the edge where you're like right on the verge of missing the deadline. Given the fact that this is a free refinance, there's no reason not to do it. Yeah, you reset your amortization clock, but you bought the rental property last year. You're not that deep into the amortization table anyway. So it doesn't really, the fact that you're resetting the amortization table doesn't really matter in any significant way. So given the fact that resetting the amortization is not a concern because you're so close to the beginning, and given the fact that it's a free refinance, there's no reason not to do it. So take the free refinance in December of 2024. Take it as late in the year as possible. In fact, actually, let me look something up real fast while we're here. So the Fed meets, let's see when the last Fed meeting is this year. So Fed Reserve meeting calendar 2024. The Fed meets 8 times per year, which is on average every 6.5 weeks. All right, so 2024. Okay, their last meeting in 2024 is December 17, 18. Okay, once again, the last Fed meeting, I'll put that down. The last Fed meeting in 2024 is December 17, 18. And then the second last is November 6, 7. Second last is November 6 and 7. I'm going to add that in. I'm going to, there we go. All right, check what's written on your loan documents. When is the deadline? So at every Fed meeting, the Fed decides if they're going to raise rates, lower rates, or hold rates steady. And specifically, just for some context here, specifically what the Fed does, the Fed determines the overnight rate, which is the rate at which banks lend money to one another overnight, because banks and credit unions, financial institutions, are required to hold a certain amount of money in reserves. Just like you and I would want an emergency fund, you and I would want cash reserves. Similarly, banks and credit unions and financial institutions are required to hold certain levels of cash reserves. They're required to hold certain emergency funds. But every day, banks have deposits coming in and out, and banks have loans coming in and out. And so at the end of a day, there are certain banks that have money in excess of their reserves, and there are other banks that have money that's less than the required reserves. And so in order to make that right, overnight, banks will lend money to each other just overnight. It's not a long-term loan. It's just an overnight loan. But banks lend money to each other back and forth overnight so that they can meet those minimum reserve requirements. The interest rate at which the interest rate that they charge one another for those overnight loans, that is the rate that the Fed sets during their meeting. And right now, that rate is between 5.25% to 5.5%. The reason that mortgage interest rates are high, the reason that they're above 7%, is because banks take whatever that overnight rate is and have to add a couple of additional percentage points to it in order to have a spread that, through which they can make money. So, um, during the Fed meetings, the Fed will set what that overnight rate is. So the last one of this year will become official December 17 and 18. That said, generally about a week beforehand, a lot of people, analysts, investors, people generally have a pretty good sense of what the Fed is going to do as of about a week prior to when they meet. So by the week prior to December 17, 18, we should have a fairly good sense of what the Fed is planning to do at its last meeting. All of that said, given that you have one free refinance before December 2024, find out what your cutoff date is. And again, talk to your lender. Find out, because you don't want to miss the deadline. So find out, when do you have to get the forms into the lender? Because it might not be on the deadline day. It might be that the lender needs to receive the forms from you several days early so that the lender can process, so find out, work backwards, reverse engineer so that you know precisely what is the latest day that you can initiate that application, and push it as late as possible. Um, push push it as late as possible in the context of timing it around the Fed meeting. So let's just say hypothetically that your deadline, your absolute latest day that you can submit your paperwork is December 1st. Okay. If that deadline is December 1st, then you might as well submit that application after the Fed's November 6 and 7 meeting. The reason for that is after the Fed has met November 6 and 7 and they've made their interest rate decision, interest rates aren't going to change in any significant way for the next 6 weeks. So once the Fed has had the November 6, 7 meeting, there's no further reason to delay it. So assuming, hypothetically, that your deadline is December 1st, wait until the Fed meeting November 6, 7, and then after that meeting happens, then submit your paperwork. So that's how you would want to time the submission of the free refinance that you're getting in December 2024. Now, all of that being said, there's a chance, there's a kind of relatively reasonable chance that interest rates might not drop at all, or might drop only a little bit by that time. November 6th through 7. I mean, we're not going to know, inflation data, jobs data, that's what's going to determine, the monthly economic data that comes out is what's going to determine what the Fed decides. But at least right now, based on current expectations, given the fact that inflation is still significantly above the Fed's 2% target, it is unlikely, and given the fact that employment is so high, it is unlikely that the interest rates are going to come down significantly. So actually, I just took a look at the CPI report for April, and April CPI report, the 12-month inflation rate based on the trailing 12 months as of April, it was 3.4%. So we're currently at 3.4% inflation, trailing 12 months as of April. And the Fed's target rate is 2%. So we're still significantly above the Fed's 2% target rate. Now, the Bank of England has stated that they expect over in the UK, they expect the UK's inflation rate to come down to its 2% target within about 2 years. That is the expectation that the Bank of England has set for the UK. The Fed here in the US has not made any kind of similar statement. Here in the US, it's more of a wait and see approach. But to the extent that that the two economies may or may not be mirroring each other in terms of inflation reduction. Um, there's at least a decent chance that inflation might not come down to 2% for another year or two, possibly. Assuming that the U.S. follows a similar trajectory to the U.K., which it may or may not. Um, all of that is to say that likely 1 percentage point lower, which I think is a good rule of thumb threshold. 1 percentage point lower is highly unlikely to happen by December. And so what I would do if I were you, so this is a long answer. What I would do if I were you is take the refinance in this year, take that one free refinance because there's no reason not. The only reason not to would be if the interest rates are exactly where they are right now. If the Fed hasn't lowered rates at all, that would be the reason not to. But assuming interest rates come down a little bit, which I think a lot of people right now are thinking they will, right? Assuming rates come down at least a little bit, you might as well take the free refi. Take that free refi. That'll lock in a slightly lower rate. And then wait for interest rates after that. Wait for interest rates to drop by at least 1 percentage point for the next refinance, the one that you yourself are going to have to pay for it. Because 1/2 of 1% for an interest rate for a refi that you would actually have to pay for, 1/2 of 1% is not really going to be worthwhile. But 1 percentage point or more is, as a rule of thumb, a good one. So, the last thing that I would recommend is refinance. Bear with me. Okay, so if you Google mortgage refinance calculator, Fannie Mae has a great one, Zillow has a great one, Bankrate has a great one. There are a lot of websites that have a mortgage refi calculator where you can bake in the cost of refinancing a loan. You can put that into the calculation. Here's the cost of refinancing the loan, and here's the amount of money that I would save. And the calculator will then produce a graph where you'll see that crossover point. Because with any refi, there's a crossover point after which, like initially, the cost of refinancing the loan in the short term makes it more expensive. But then it crosses over where the savings generated by virtue of the lower interest rate exceeds the cost of the refinance. So you want to be looking, use a mortgage calculator, look for where that crossover point is. And if it's a crossover point that is relatively shorter term, like 2 years, 3 years, um, that's when you know that this refinance is a good idea based on the amount of the decrease in interest rate and the cost of closing on that new loan. So, uh, so in summary, take the free one because why not? Assuming that rates are at least a little bit lower than they are right now, which I think likely they will be, but we'll see. But I think likely they will be. Take the free one in December, and from that point forward, 1% is a good rule of thumb, but use a mortgage calculator in order to see where that crossover point is. So, those are my answers to those two questions. I want to open this up to those of you who are watching live. Thank you so much for being here live. If you have any questions, please leave them in the comment box. Sorry, bear with me. I have a bit of a cold right now. It's like nearly July. I've got my cough drops here on my desk. I don't know how I got a cold in almost July, but here we are. Okay. And I am not seeing any questions coming up live. So, all right. If there are no live questions, then I'm going to sign off right now. But thank you so much for joining. Thank you for being part of this live stream. And I will catch you in the next live stream. I do these relatively frequently. So I'll see you at the next one. If you have not yet looked at affordanything.com/enroll, that is the just go to that website. Go check out that page. You'll see loads of information about our course, Your First Rental Property. It is available this week. Um, yeah, so check it out. Uh, all of your questions will be answered right here, affordanything.com/enroll. Tons of information. It's a very white glove, like hands-on experience with a lot of student support where we really walk you through how to make these very complex decisions about rental property investing. So thank you again for watching this. Thank you to those of you who are here live, and I will catch you in the next one. Take care.